There's one thing I do with every retirement client that saves them more money than any individual strategy I could ever hand them. It's not exciting, it's not clever, and honestly, the first time I explain it to somebody, they usually look at me like I just handed them homework. But the families who actually do it save real money in taxes every single year. And the ones who skip it consistently overpay, not because they don't know the strategies, they usually do, but because they're making every financial decision blind and finding out the cost months after it's already locked in. My name's Daniel Miller, and I help families steward their wealth with purpose and generosity. If you like content like this, consider liking this video and subscribe for more. So let's get into it. Here's the most boring, most valuable thing you could do for your retirement taxes. It takes about an hour once a year. And once you see how it works, you'll wonder why nobody told you about it sooner. Here's what actually happens with most people's taxes in retirement. Throughout the year, decisions get made one at a time. An IRA distribution in March because cash is needed, or some stock gets sold in June because an advisor rebalanced. Maybe your Social Security shows up every month like clockwork, or you could have a check that goes to church or your favorite charity in December. Every single one of those feels completely reasonable in isolation. And I agree, nothing about any of those decisions individually are that big of a deal. In fact, they're all pretty standard and healthy financially. But then April rolls around and taxes get filed. And almost every time there's a surprise. The bill is higher than expected, or the Medicare premium jumped and nobody knows why. Or more of the Social Security check turned out to be taxable than anyone realized. And the accountant explains what happened, which is nice, except by April it's useless information. The distribution already happened, the stock's already sold, the threshold is already crossed, and there's nothing you can undo. And that's not a strategy, that's an autopsy, examining what went wrong well after the damage was already done. And here's the part that surprises people. It's usually not a knowledge gap. Most of these folks have heard of Roth conversions. They know withdrawal order matters. They've read an article about Medicare surcharges somewhere. But knowing the strategy and being able to use it are two completely different skill sets. And you can't use any of them if you don't know where you're standing right now, today, this year. So here's the boring thing that fixes it. And fair warning, it's going to sound almost insultingly simple. The annual tax map. Every January, before a single financial decision gets made for the year, I sit down with clients and build one page. We call it the annual tax map. It takes about an hour. It's the most boring thing we do together all year, and it's also the most valuable. Here's what actually goes on the page. First, every source of income expected for the year gets listed out. Social Security, pension, if there is one, consulting or part-time income, required minimum distributions if that age has been hit, rental income, interest, dividends, all of it added up. And that's the baseline income before a single voluntary decision gets made. Second, that baseline number gets mapped to this year's federal tax bracket. Not last year's, this year's, because thresholds move annually. And third, the room between that baseline and the top of the current bracket gets calculated. This is the number that changes everything, because that room is what tells you how much you can actually do, convert, withdraw, sell, give before the next dollar costs more. Fourth, the real thresholds get marked on the page. Where Social Security shifts from up to 50% taxable to 85% taxable. Where Medicare premiums step up to the next IRMAA tier. Where the 0% long-term capital gains bracket runs out. Where's the net investment income surtax kicks in. These figures move with inflation adjustments and current law, so the exact numbers get pulled fresh each year rather than remembered from the last one. Fifth, the gap between where someone sits and the nearest threshold gets circled. And that gap is the planning space. It's the answer to almost every tax question that comes up over the next 12 months. And that's genuinely the whole thing. 5 inputs, 1 page, 1 hour in January, and suddenly there's a map for every financial decision for the rest of the year. Now let me show you what it actually looks like to use it, because this is where the savings start showing up. Once the map exists, watch what happens to decisions that used to be guesswork. Should a Roth conversion happen this year? Check the map. If there's $18,000 of room before the next bracket, up to $18,000 converts at the lower rate. Cross that line without checking, and the extra dollars get taxed at the higher rate instead of an avoidable cost, sitting right there on the page the whole time. Should an extra IRA distribution get pulled this year? Check the map. If the Social Security taxation threshold is $6,000 away, that's the real ceiling. Pull $5,000, stay under it. Pull $10,000, and a chunk of Social Security that didn't need to be taxed just became taxable. Thinking about selling an appreciated investment? Let's check the map. Depending on where your total income lands, there may be room in the 0% long-term capital gains bracket, meaning the sale could genuinely owe zero federal tax on the gain. But if we sell in the wrong year without checking, and that same gain gets taxed at 15% for no reason other than bad timing. Planning a charitable gift? Check the map. For anyone 70 and a half or older, a qualified charitable distribution routed straight from an IRA can satisfy part of a required distribution without ever showing up as taxable income. If you write a check from the bank account instead, that opportunity's gone with nobody telling you it existed. Every one of these used to require a phone call, a guess, or crossed fingers. With the map built, the answer's already sitting on the page. If you want my team to build your annual tax map and walk you through exactly what it means for your decisions this year, we'd be honored. A lot of advisors don't offer this service at all, and they're going to want to manage your investments, and they still ignore things like this. If we manage investments, we include services like this. For those of you that want to manage your own investments, I also offer this service as part of a flat fee arrangement to help give the clarity you need while allowing you to keep your investments where you have them. If either of those are intriguing to you and you want to learn more, check out my website. I break things down there and we can go over it on a call if you're interested. The link to do so is below. Now let me show you what it actually costs people when this doesn't exist. I want to make this real, so here are two situations I've run into. Not hypotheticals pulled from a textbook, but actual patterns that show up constantly. The first one is a retired couple with a combined income around $91,000 between Social Security and required distributions. In October, they sell a rental property, and it nets them a $40,000 gain. The total income for the year jumps to roughly $131,000. That gain does three things at once, none of which anyone flagged in advance. It pushes them over the line where 85% of Social Security becomes taxable instead of 50%. And that alone can run somewhere in the range of a couple $1,000s in additional tax. It crosses an IRmaa threshold, meaning Medicare Part B premiums step up a tier 2 years later. And for a married couple, that can add up to a few $1,000s more in healthcare costs down the road. And the capital gain itself. Instead of landing in the 0% bracket, it now gets taxed at 15% because the rest of their income already filled up that space. When you stack it all together, and one untracked decision can cost somewhere in the neighborhood of several $1,000s in additional taxes and future premiums. Obviously, the exact number depends on the household's specific numbers, but this is still an illustration of the mechanism. And had the map existed, splitting that sale across 2 years or timing it into a lower income year were both real options. They just weren't visible. The second one is a single retiree sitting in the 12% bracket with roughly $22,000 of room before crossing into the 22% bracket. She had heard Roth conversions were smart. So in November, $50,000 gets converted in one move. The first $22,000 gets taxed at 12%, but the remaining $28,000 spills into the 22% bracket, costing her thousands more than it needed to cost, and that's before the ripple effects. That $50,000 also counts as income, which can nudge Medicare premiums up and make more Social Security taxable all in the same year. That same conversion split across 2 Januaries instead of jammed into one November, and that entire spillover disappears. It's the same total amount moved, but it's meaningfully less cost to move it. And the map doesn't tell anyone what to do. It tells you how much you can do, and that distinction is the piece that almost everyone's missing. Now, you might be thinking this sounds like something you need a professional to build. And honestly, for the precise version, that's probably true. But here's how to start your own. You don't need software for a first pass at this. Here's a basic version that's doable this week. 1. Grab a blank page and list every income source expected this year. Social Security, pensions, distributions, part-time work, interest, dividends, rental income. Add it all up, and that's your baseline. 2. Look at this year's federal tax brackets for your filing status and find where that baseline lands. 3. Calculate the gap between that baseline and the top of the current tax bracket. Write that number down, and that's the planning space for the year. 4. Look up the current IRMAA thresholds and mark where you sit relative to the nearest one. And 5. Look up the current provisional income thresholds for Social Security taxation and mark those too. Look at that page now. You have your baseline income, your bracket, and the room that you have left. The thresholds that actually matter. And that's more tax visibility than most retirees ever build for themselves. Now, it won't be perfect, and a full version accounts for state taxes, capital gains brackets, the net investment income threshold, and the specifics of which accounts the money's actually sitting in. But even the rough version puts you miles ahead of flying blind. The worst version of this map still beats having no map at all. And here's the part that makes doing this worth it for the rest of retirement. The savings compound. If the map helps avoid a few $1,000s in unnecessary tax and premium increases in year 1, that's meaningful on its own. But this gets rebuilt every January for as long as retirement lasts. New income, new thresholds, new room, new decisions. If you run that same few $1,000 range over a 25-year retirement, and the cumulative direct tax savings can land well into 6 figures for some households. And the money that wasn't sent to the IRS stayed invested, which means it kept working the whole time too. The practice also gets easier. Year 1 is the hardest because the thresholds are unfamiliar. By year 3 or 4, the landscape is known, and the map takes half the time, and the decisions stop feeling uncertain. Here's a story that stuck with me. Early in my career, I had a client named Frank who did his own taxes for 30 years and was genuinely proud of it. The first year we built his map together, he found out a Roth conversion he'd made 2 Novembers earlier had spilled $12,000 into a higher bracket he never intended to touch. A decision made in about 10 minutes, sitting in his kitchen with no idea where the line even was. He wasn't careless, he just never had the page in front of him. And that's really the whole difference between the families who build wealth efficiently and the ones who don't. It's rarely intelligence. It's whether someone's building this map for them every January, whether they think about it consciously or not. Nobody's posting their annual tax map on social media because it's not glamorous. But it's the one practice that makes every other tax strategy you've ever heard of actually usable, instead of just an idea you read somewhere once. Now that you know the practice that makes tax planning actually work, the next question is whether the accounts producing that income are even structured the right way to begin with. I made a video on the 3 rules the wealthiest families follow when managing their 401k. These are rules most people were never taught. And if you want your largest retirement account working as part of a coordinated system instead of on its own, that's the next one to watch. I'll see you there.